Hey everyone. 2025 has been a bit of a choppy year for commercial real estate. We recently finalized our second quarter fundamentals, and we're starting to see the impact of policy changes, elevated uncertainty, and a weakening economic outlook. The shift in space demand is most apparent for retail and industrial properties. On a national level, quarterly retail space absorption averaged about 11 million square feet in 2023, then 5.5 million square feet in 2024. And in the first two quarters of 2025, total retail space absorption has run negative, falling by an average of 7.3 million square feet per quarter. When I looked at the trend across 43 major markets, the loss of momentum seems to be spreading. In the fourth quarter of 2024, just 11 metros had negative absorption for that quarter. In the first quarter of 2025, a total of 27 markets had negative absorption, and in the second quarter of this year, 34 retail markets had negative absorption. The space demand reduction wasn't severe. Most of the losses were minimal, just 10, 20, maybe 30 basis points as a percentage of inventory. But I think the spreading weakness in space demand reflects falling CEO confidence and increased retailer caution. 9 major metros still had positive retail space absorption in the second quarter, led by Phoenix, Dallas, and St. Louis. Looking forward, retail space demand will likely remain choppy, with the outlook hinging on what happens with tariffs and economic growth. Industrial absorption also tapered. In 2023, the average national quarterly absorption was 41 million square feet. In 2024, the market averaged 22 million square feet. And in 2025, the first quarter was positive 20.8 million square feet, but in the second quarter, it was negative by almost the same amount. Looking at the markets, 19 metros had negative space demand in the fourth quarter of 2024. That fell to just 16 markets in the first quarter this year, but in the second quarter, 35 metros had negative absorption. A couple of markets, Baltimore and Denver, both had a sizable shift in demand that pushed vacancy up substantively. That said, 13 major metros had positive space demand in the second quarter, led by Dallas, Phoenix, and Houston. Now, office demand has gained momentum. If you look back at the first quarter of 2024, 27 metros had negative absorption, which drove nationally negative space demand of 11 million square feet. But since then, for the last 5 quarters, the overall national office space demand has been positive, averaging about 18 million square feet per quarter. And in the second quarter of this year, we're looking at a flipped script. 28 of the 43 markets we're tracking delivered positive space absorption for the quarter, led by New York, Tampa, and Charlotte. In net, office vacancy rates fell in 22 major metros in the second quarter, led by a 120 basis point vacancy drop in Jacksonville. And the office vacancy rate in Columbus, Ohio, San Jose, and Tampa all fell by 70 basis points for the quarter. So the office market is starting to look healthier, but additional progress will likely hinge on CEO confidence, the employment market, and the overall economic outlook. And finally, there's the multifamily market. Nationally, we've had 10 quarters of positive multifamily absorption, although the significant development of new units has overshadowed the total demand. That said, national vacancy rates have fallen for 5 consecutive quarters, and the absorption of nearly 800,000 units in the last 4 quarters is the strongest 12-month demand cycle on record. In the second quarter of 2025, all 43 major markets had positive unit demand. In fact, over the last 4 quarters, 41 metros had positive absorption every quarter. The exceptions were Orange County and West Palm Beach, which each had 1 quarter with slightly negative space demand in last year. As a result, the multifamily market continues to outperform expectations. And for apartments, the potential direct impact of tariffs is nominal. If the overall economy falters and we go into a recession, that could slow the momentum. But even still, with the pace of multifamily construction slowing dramatically, most markets would likely at least tread water. The next couple of quarters will likely be choppy for all property types. But if trade policies stabilize and a recession is averted, as most economists predict, then slow but steady economic growth should invigorate space demand for all types of commercial real estate while construction remains muted. And that trend would drive positive commercial real estate fundamentals in most markets, which is why investors always need to keep their eyes on the horizon.